Pierre Poilievre just revealed his economic plan, and he's spending about $100 billion more than he promised. Well, not exactly, but he's spending a whole lot more money than he originally anticipated, and he is putting the country in a lot of debt. Now, whether or not you think that's right or wrong, or up or down, doesn't really matter, because the Conservatives just came out with their housing platform, and there's some positive, some negative, and there's a lot of question marks. So as a brief overview, today we're gonna break down his key promises, the real numbers behind them, and then what they really mean for your wallet and your mortgage, and of course, the real estate market as a whole. But let's get into it. So PP announced a new plan that's gonna put us in a $31 billion deficit, totaling $100.6 billion over the course of the next 4 years. Now, as a brief comparison, if we look at Mark Carney's plan of $129.2 billion, this really doesn't look too bad. Not great, but not nearly as terrible. The economic forecasts right now are somewhat unreliable, and they're about as reliable as we can say right now as a long-term weather prediction 30 days out. And so to understand specifically what the impact would be of these higher deficits would be hard to say, but looking at past history is very important, and understanding specifically what's gone on will help us to dictate roughly what could happen in the future. So higher deficits obviously typically lead to mortgage rates that increase over time, which means yields go up, pushing bond yields up, which of course costs you more money from a mortgage rate perspective. And we're seeing that model out right now in the current rate map. Of course, this eventually makes housing more expensive for the average Canadian borrower. Let's talk about the actual details of Pierre's plan and the pros and cons associated with that. So Pierre Poilievre pledges to build 2.3 million homes in Canada. We talked about this before, but removing the GST on new homes priced under $1.3 million, which they anticipate would give Canadians savings of around $65,000 per home. Now, a little side note on that comment, I heard feedbacks from some developers who will never put this in writing that they just increased the price point to make up the difference in their profit. But of course, that really comes down to what they could sell properties for. Regardless, most people would be happy, less taxes, always a good thing. The commitment that he made was to never allow capital gains taxes on primary residences. Now, I know that's something that a lot of Canadians should be able to get behind. And if this boomer community is out there listening and they're sold on the liberal market, this is something that will give them a wake-up call, because a lot of the boomers that are out there have their equity and money tied up specifically in their primary residences. So this should tap into some of that particular community. The other factor, he said, is he's going to end the underused housing tax, reducing the barriers for foreign buyers. Another thing that's being lobbied for specifically for new developments in the country. Of course, we do need foreign money to build, and so it's not as evil as some people say. It just needs to be looked at and considered, and so I do like what he's doing there. Ending the Housing Accelerator Fund is another factor that they're considering. It's a controversial decision considering that it's meant to speed up housing, but their intention is to do things a little bit differently, which we'll talk about right now. Pierre also mentioned that he's going to introduce the Taxpayer Protection Act, which is no taxes without a referendum. He's also suggesting there's going to provide a reduction in the lowest personal income tax rate by 15%, slightly boosting disposable income, though that really won't positively impact overall mortgage qualification. It's certainly not something that we're going to see in any of the major cities or communities across the country. Additionally, they're going to allow working seniors to earn up to $34,000 tax-free. I can get behind that for the most part. Also raising the RRSP to RRIF conversion age from 71 to 73, which is helping seniors manage retirement savings a little bit longer than they had in the past. Now, whether or not you agree that RRSPs are a good vehicle, I think there's a large portion of the country that is currently using those. Let's give you a little bit of an impact or analysis. Let's start off with the pros first, based on this from a real estate perspective. Number one, the immediate affordability improvement for new home buyers when it comes to GST. We did mention that earlier on, that some of the developers are suggesting they're just gonna juice up their price points based on the amount of GST that they won't get. But that suggests that those properties will sell fast. And I can tell you right now, based on the fact that the supply is sitting for a lot of new developments, unless it's a desirable property like a single family home, chances are this will actually probably reduce prices, at least right now for home buyers. So we give that a thumbs up for today, at least. They also suggest they're going to protect homeowners from potential capital gains. I like this because, hey, it's your primary investment, and there's enough rules, restrictions, and flipping laws in place that we really need to tax someone for owning their primary residence. That seems insane to me. Additionally, not necessarily on the housing front, but the positive for seniors and lower income earners, giving them more disposable income probably is a good thing. Canada's a very expensive country to live in, and I'm not against helping the lower class or the people with a little bit less money get by, particularly seniors who have lived in our country for a long time. Now, some of the cons here would be, first of all, the significant deficits could mean higher lending costs. Now, this is an issue for both the Liberals and the Conservatives, and I'm not sure that we all thought that was going to be fixed by either platform, but the fact that they're going to be spending so much money is going to raise the cost of mortgage funds, therefore raise interest rates and end up costing Canadians more money. And unless they come up with some kind of solution there, both of these, and I'm not going to say anything, guys, will end up costing our country a lot more money and Canadians a lot more money in just mortgage rates alone. In addition, removing the Housing Accelerator Fund might slow down the long-term housing supply unless they can come up with a new solution. They said that they're going to start selling government land and they're going to focus on the CMHC legislation, like how CMHC is run, to help out make sure that it is being more effective and more efficient. Again, there's not really a clear plan in place, so I'm not sure exactly what that means. Another con here is that we're somewhat skeptical about the fact that the ambitious target of the 2.3 million homes, because there's not really a clear plan other than to say that they're suggesting that the city will have building targets, and if they hit those targets, the cities will get more money available to be able to build more. Now, this could be a good thing in some cities, but the problem is, again, is this going to end up being a whole bunch of condos when we really need single family homes? I don't know, but again, there's a lot of questions here. So what does this mean for you? Now, the first thing is if you're buying a home soon, wait if you're buying a brand new property. If you're buying something under $1 million, whether it's the Conservatives or Liberals, in either case scenario, they're going to cut GST on $1 million homes, very likely. And so if you're going to buy a brand new property, maybe hang tight for another 30 days, assuming they actually fall through with their promise. Number two, if you own already, this protection from the capital gains tax is massive. So it's another win for people who own their primary residence. You can obviously cheer quietly or loudly that you're not going to be taxed on that like everything else in this freaking country at this point right now. Number three, I would suggest that you be really cautious about your mortgage affordability right now. With rates potentially going up, this could negatively impact consumers. And more specifically, if we're looking at this from a long-term perspective, as I mentioned in the beginning, very difficult to forecast interest rates very far out. All of the forecasts right now are proposing that interest rates are going to go up somewhere between 0.75 to 1% over the course of the next 4 to 5 years. So mortgages are going to be more expensive, and particularly at a time in 2026 and 2027, when a vast majorities are going to come up for renewal, this could unfortunately negatively impact Canadians across the board. A couple key thoughts here, just from a recap perspective. As mentioned, there wasn't a lot of juice in this overall plan or strategy. Wins, no capital gains tax, losses, ambiguity. I think that I was expecting a little bit more. I still like it better than the Liberal platform because they're spending more money and we don't need to spend more money. I'm just hoping to get a little bit more clarity on this program and how it fits in with the items around not having to pay capital gains tax on investments or the potential of that 1040 exchange. There's a lot of questions here. I'm not sure exactly where he's going with this, but if you like this information and you found this valuable in terms of making a decision, please go ahead and like, subscribe, and we'll see you on the next video.